TheoTrade. This is Don Kaufman. August 31st, 2022. Just about 5 minutes to go to the cash close here on this Wednesday afternoon. S&P 500 is just downright all over the place. I think the only way to describe some of the intraday trade today, it's just sketchy out there. High volume. The S&Ps are bouncing all over the place. We're not trading linear. Linear would mean, look at this, down 1750, down 18. We're jumping down 19. People, again, it is sketchy over there. Now, the crux of this evening's video is very, very specific. And it's about when oversold and oversold conditions, it just does not matter. I kind of feel like everybody right now, they're trying to time this, the quintessential rip your face off rally to the upside because, hey, look, we can all look at the exact same chart. And in that chart, you can probably scream, we're wildly oversold. I'm going to give you a number of factors on this evening's video to express to you when oversold just simply does not matter. As we come into the cash close, you can see the S&Ps, I would say drifting lower, but this is not drifting. There is some heavy contract size, and we are making a valiant effort to sell off. So let's get to some of those factors about where oversold just simply doesn't matter. All right, number one, I think you have to recognize there's some decent size economic data coming out. Tomorrow we can look at like PMI. All right, you can talk, till you're blue in the face about all the economic data, construction spending, ISM. Oh my, okay, push that aside. Obviously on Friday, we get the mother of all numbers, the employment situation. It's neither here nor there. Those are not the factors that I'm presently looking at. Those are catalysts for the marketplace. But that's not really going to impact whether we're oversold in this marketplace. What is, again, very disconcerting at this point in time, I want to start, with the dollar. If you're not looking at the dollar, well, you should start looking at the dollar. Be a little bit concerned at this point. The dollar right now looks like it's just poised for an absolute wicked breakout to the upside. Now, does that have to transpire? Of course not. But if it does, it's probably indicative, of duck and cover. Lately, buying dollar has been extraordinarily bearish for S&Ps. It used to be sell S&Ps and buy bonds. Nobody's buying bonds, pretty evident. Right now, it's sell S&Ps, buy dollar. Now, is the dollar trading higher today? No. However, again, it is poised, to break out to the upside. And again, you've got this confluence of events with, some data drops. So there's going to be some big binary data drops. And that binary just means I'm not going to assign a bullish or bearish to what I think of the jobs number. Because quite frankly, the jobs number could be spectacular. They'll kill the market because the assumption is the Fed's coming for you. Or better yet, the jobs number could be terrible and they'll still kill the market because they're like, look, the Fed's killing the jobs market. This could be a lose-lose. What I don't like though right now is a binary announcement when a critical component of the market as of late is poised for a breakout. And the breakout higher unequivocally to me means sell side in the S&Ps. The next aspect that I want to bring into scope, I don't like what's going on in volatility. You're seeing the S&Ps slip. The volatility isn't skyrocketing. Now that, people listen, that's not news, The market has seen this movie before. And what that ultimately means is, hey, listen, the market's seen degrees of risk, As the market sees degrees of risk, all right, the volatility goes up. But once the market has seen that risk, which it has, it saw it back early in the year. It saw it again in late February and in March. It saw it again in April and May. Yet it saw it again in June. So, the fifth or sixth time is the charm. Listen, unless we crack into unforeseen areas, okay, of debauchery in this marketplace, look at this. As I said, this S&Ps are sketchy, right? Why should you assume that the volatility would spike here? Okay. All right. Listen, we break through some of the new lows. You just got to look at this and say, hey, if this marketplace is going to come apart, you're going to have to see something really scary to get volatility rocking. But there is one critical component, because how does this relate to a marketplace, and this, hey, oversold means nothing. I'll tell you exactly how. If we start to sell off, I'm not talking on an intraday basis. I see that we're coming into the cash close. Here is the closing bell. So I see the sell side activity the same as everybody else. Okay. But if the sell side activity really starts to pick up and we're ready to start to break through some of the lows, okay, the problem with the volatility right now, it is inherently low. So volatility will start to take off to the upside, and volatility going up. And for example, the volatility futures themselves going from contango, and they are in a wildly large contango. If they go from contango into backwardation, that unto itself, okay, will actually cause significantly more sell side activity. So it is almost like a catch-22, because everybody's like, oh, we're oversold. The oversold doesn't matter. Oversold doesn't matter when you have like a 26 VIX and the S&Ps have done what? I mean, hey, look for yourself over here. The S&Ps have just come down from 4,300 to, we'll call it 3,950. Now, oh, hey, listen, what's 350 S&P points amongst friends? Because at 350, S&P points, what did VIX do in the same time frame? Oh, I think it moved. We moved from roughly 20 up to about 26. Yeah, in percentage terms, it's big, but it's nothing in comparison to some of the moves that we've seen prior, right? So again, you have to actually understand that oversold doesn't mean much. Okay, in a relatively low volatility environment, dollar is poised to break out. Okay, the other aspect we've got going for us, I don't like the bonds. The bonds continue to slip lower. As the bonds continue to slip lower, if we see more sell side activity in these bonds, rates are going higher. Rates going higher. Yeah, big tech is not going to like that. Big tech has actually held up rather well, in my opinion, specifically today. I mean, they're only down about 0.5%. All that's going to change, though, if all of a sudden these bonds start to sell off. Again, when oversold doesn't matter, I'll tell you when it doesn't matter. The bonds continue to sell off. If the bonds oversold, you better believe it. I don't care what technical indicator you look at. You want to see oversold? Let me redefine oversold for you. This is an RSI of the gear. Oversold. I mean, it's literally as oversold as it could possibly get in here. That's when oversold doesn't matter. If the bonds continue to sell off, though, it's going to take the Nasdaq along with it. Last, but definitely not least, you got to come into the SPX, the mother of all products. I want you to look at the close inside of the SPX. You want to know when oversold doesn't matter? Okay, when we're about to hit the edge of the expected move. No one cares at this point. The edge of the expected move. This is the lower edge of the expected move. We're home. Okay, the S&P's actually sold off just the last couple of seconds right into it. I mean, you can't make this stuff up. Here we are on a Wednesday. The SPX itself had a low of 39.54. That lower edge sits at 39.50. Oh, okay, we're 4 points off of it. What's 4 points, though, to a, almost $4,000 product? It's pretty much a rounding error at this point. When oversold doesn't matter, if we actually break below the edge of the expected move. Last, but definitely not least, we have an absolutely marquee level inside of none other than the S&P futures. And that marquee level, I'm going to zoom right into it. Oh, we're a hop, skip, and a jump north of it. It's 39.31. This is something I've talked about just incessantly on the weekend updates and so forth. Big levels. We are coming in, people. 39.31 is a hop, skip, and a jump away. So if we do start to lose, again, if we start to lose the lower edge of the expected move this week is about $108. If we start to lose the edge of it, I can see us coming right down to the 39.31 before a little bit of a bounce at that point. But I have to tell you, this is a rough area. If you come under 39.31, and of course we would have to reassess conditions at that point in time, markets could get downright hideous on us. Listen, okay, you've got to understand that you have this just, almost perfect storm of events. Dollar's ready to break out. Bonds look like they're absolutely going to crash on us right here. okay, taking interest rates higher, killing the Nasdaq. You've got the volatility complex, and the volatility complex, it's not that complex. All right. I mean, the whole key to it over here is if volatility does start to skyrocket because the S&P sell off, it is going to spread the selling. It's going to be harder, faster to the downside than you have seen yet. Again, oversold in this marketplace and these conditions, they don't matter. Can the S&Ps bounce? Of course. Unequivocally, they can bounce. But you've got to get the logic of oversold out of your head at this point in time. Thanks, everybody, for joining us here at TheoTrade. Have a wonderful evening. Bye-bye.